Joining us right now to talk about that is the president of U.S. Trust, Keith Banks. Good to see you, Keith.
Good to be here, Maria.
So now that Donald Trump has won, what's the strategy? Do you change strategy as an investor?
We think you do. Our expectation now is you're going to see higher nominal growth, higher inflation, higher interest rates. And because of all that, we think you need to start positioning more for greater exposure to value, because value should outperform growth, as well as much more cyclicality, as opposed to what a lot of people were doing, which was the get paid to wait strategy, which quite frankly is much more defensive in nature.
Where's the value? I mean, look at the financials. They really rallied on the Trump win. Is there still value there?
We think there's value in general. I mean, you could see a pullback at the beginning of 2017. A number of things
just
could drive that.
Just from the run-up.
Just from the run-up. We think you'll probably end this year around the highs, maybe get a 5% pullback early in 17. But we think next year you could see nominal GDP growth approaching 6%, assuming inflation is approaching 3%. If you get that, obviously that's good for revenue. The lack of inflation, Maria, is what's been really making it hard for companies to generate top-line growth. So that'll help revenue, by definition, earnings. Valuations could stay somewhere around 18 times. If you believe all that, you can see at the end of next year a pretty good return in the S&P again.
Wow.
So that's a huge jump in inflation to up to 3%.
Huge jump in growth.
And growth, yeah.
Right.
But I mean, that seems, I would expect a little bit more inflation, but you don't think it could ramp up that quickly?
Well, look, we think two things are happening. Number one, we've been in what we've been calling the mid-cycle phase of the economic recovery. We think you're going to move into the late cycle phase. So typically, when you see the late cycle, you do see more inflation because you have a tighter labor market. Unit labor costs are going up, and they are. And
that's the biggest contributor to inflation.
Very high correlation there. Not to mention the fact that if we see just a general pickup in growth, if in fact we get some fiscal stimulus, which we do believe we will see, time will tell what it looks like, but we think that's a pretty safe bet. All that we think can really come together, and you see inflation continue to tick up, and along with that, interest rates, especially at the long end.
The government bond market went a long way in the last week and a half to factor in your forecast in terms of more borrowing, more inflation, better growth. At what point, with the 10-year yield at almost 2.34%, at what point does that then get in the way of valuations and hurt stock market valuations?
Yeah,
at what level?
Great point. So we think actually the 10-year Treasury could end next year if what I just said actually comes to pass. And keep in mind, we're dealing with pretty incomplete information right now. So this is what the tea leaves are telling us. We'll see as more facts and information comes out. But we think that you could see a 10-year Treasury at the end of next year closer to 3%. We don't think that derails things, because keep in mind, I mean, it's high versus what we're used to, but what we're used to is so historically low that we think the economy can continue on as I suggested.
Where do you see the dollar in the next month to come? We read about a dollar-euro parity or potential dollar-euro parity this morning.
That's in the Journal today, yeah. Right.
Well, look, I think the dollar definitely strengthens initially, especially as the differential in growth becomes more apparent, the differential in rates as we begin to, you see the Fed tightening. But we think as growth in Europe accelerates, as growth in Japan accelerates, we think then the dollar will stabilize at levels that will not be too damaging for the overall economy.
So let's hope that Europe stays stable.
Yeah, and look, the trick with Europe right now, as you know, is you have the referendum in Italy, then you have 3 key elections coming up. So we got to see how that all plays out. So there is some uncertainty there.
So and then there's oil, just pointing out, up 2% today, Keith. Would you buy energy?
We think energy will be one of the beneficiaries of, again, growth in general. So yes, that would be an area that you got to pick your spots, but that would be one of the areas, one of the sectors that we think will benefit.
A stronger dollar, possibly falling corporate tax rates, and possible trade tariffs. Those are all things that are good for small caps. Do you have an opinion there?
We agree. We think people are going to be moving more toward small cap, more toward domestic-oriented industries, because they're the most direct beneficiary of growth, and also you protect yourself against possible trade retaliation if that, in fact, comes into play.
Yeah.
The Russell 2000 is already at a record.
Yeah,
So,
right.
I mean, how much more can they run at this point? In terms of the valuations, how does it look?
Well, look, one of the reasons we think you could see a pullback early in the year is valuations are getting a bit extended. However, again, if you see the pickup in growth we're expecting, and that translates, then we think you're okay, and you can start to move to higher levels.
Keith, your Bank of America's Global Wealth and Investment Management Division recently named you head of its newly created Chief Investment Officer. You have a new role.
Yes.
Congratulations.
Yeah, it's in addition to running U.S. Trust, so thank you. I appreciate that.
Do you see any parallels to the 80s, potentially?
In
With
what
fiscal
sense?
stimulus to the Reaganomics, if you look across the borders, and some outcome maybe in Latin America and other places that might be extremely negative?
We think the emerging markets may be the odd man out here for that reason. Stronger dollar, higher rates. But the one thing that's been missing is fiscal. We've had monetary, but the 1-2 punch is usually monetary followed by fiscal. We think you're going to now get that, which is good for U.S. growth and global growth.
So U.S. growth, you want to buy U.S. Would you recommend U.S. over Europe or over emerging markets, I hear you saying?
Yeah, we think that emerging markets could become difficult for those dynamics.
All right, we'll leave it there. Keith, good to see
Good.
you.
Always
Thanks so
great to
much.
be here. Thank you,
Keith
Maria.
Banks, President, U.S. Trust.